Can you explain capital gains and losses? And does the IRS see a net of the gains and losses?
Yeah, so this is a question that came in. Can you explain capital gains and losses? And so there's lots of different types of losses, business loss and all these things. But in our particular case, you invest some money in in a stock, let's say, and it drops or it gains, right? And you sell it. There's some accounting to be done potentially. If it's in your IRA or your Roth IRA, nicely, you don't have to do anything about it. Those just get, you only have to deal with those upon withdrawal, right? So if I've got a taxable account and I'm going to take a gain, we do have a visual for this. Let me share that. All right, so let's just say there's two different types of gains, short-term and long-term. I guess there's four. There's a gain and a loss.
Yeah.
But those are kind of obvious. Short-term is something you've held for less than a year, and long-term is something you've held for more than a year. Simple enough. And so, again, this is one of the reasons that when we have a taxable account, we try to let them float for longer before we get defensive or deal with it, because we don't really want to generate short-term gains if possible, because there is a tax difference. Long-term gains are what I think the tax brackets are 0, 10%, 15%, 20%.
I think it's 15 and 20. There's no 10%.
No 10 now? Okay.
And then they have the 3.8
Oh, yeah. That,
additional tax.
the healthcare tax, exactly. And so it takes quite a bit of money to get into the 20% arena. So a lot of our clients end up in the 15% bracket, which is, it's not bad. And overall, ordinary income is how they handle the short-term gains. So it just becomes part of your ordinary income. And then it depends on what other income you have. And so we have an awful lot of clients that are going to say the 22%, 24%, even 32% bracket on their ordinary income, which is a lot more than 15.
Yep.
And so that's why you'd rather have a long-term gain than a short-term gain. Now, you can, and what they're talking about is netting out, right? And so we've got an example here. So the net of the short-term is
5,000 loss.
5,000 loss, okay? And so because we've got 5,000 gain, these are multiple transactions that happen during the year. And a $10,000 loss, you're out 5,000. The net on long-term gain is 8 minus 1 is $7,000. Yep. Now you can net those two out, okay? Short-term losses can be used against long-term gains. Awesome. Net gain is 2,000.
Yep.
However, if you reversed it, you couldn't do that. So in other words, long-term losses cannot offset short-term gains.
Yeah.
So for example, if I had a $1,000 long-term loss net, I couldn't write it off against my $5,000 short-term gain. So I have to have short-term losses against short-term gains, right? So, but short-term losses are valuable. You can use them for anything.
Yep.
And it's what they call tax loss harvesting, something we employ a lot to try to gather those, because you can also carry it forward. Yeah. And so that's the next example. Now we have a $1,000 capital gain on short term, same $10,000 loss, and a $5,000 long term gain, $3,000 loss. So you look at that, you got a $9,000 short term loss and a $2,000 long term gain. You can't offset those. You got a negative 7,000. So now what happens?
Well, you can use 3,000 of that to offset your ordinary income. So, but you're still left with $4,000 of capital gains. And so they have a carry forward rule, which allows you to carry that to the next tax year and then use it against future gains.
Yeah, exactly. So I mean, it's kind of nice. The 3,000, is right off your income. If you made 30,000, now you're making 27,000. I mean, basically, it's a write off. That's nice. But the other 4,000 then would have to be used against some type of gain. It can't go against that. Ordinary income is kind of money you make in a job, for example, whether that's a 1099 job or a W-2 job, those type of things. So there's lots of other ones, but that, for simple purposes. So now I can carry forward that $4,000 loss. And so that's why you want a tax loss harvest, because, and if you have something that you want to move out of, and it's at a loss, take it and gather it. And even if it's more than you need, you can use it year after year until you deplete it against future gains. So if you have like a $50,000 carry forward, that just means that you're going to be able to take $50,000 worth of gains in the future at zero tax.
Mm-hmm.
Terrible to lose 50,000, but it's a way to use it.
Yeah.
And so you do have to be a little bit careful about gathering those short-term gains, because they have a thing called the wash rule. And so if you sell, let's say, Apple at a $10,000 loss and then buy it back within the 30-day period, you no longer have a $10,000 loss. It gets wiped out.
Yeah, your basis just changes on that stock, essentially.
That's right. And so that is not what you want to do. So you want to wait for that 31 days. And then there's other risks. Maybe Apple jumps and you could have had $20,000 during that period, so it's very difficult to do. Usually when we're doing tax loss harvesting, it's because we're going to something else. We're not going back into the same thing in 31 days. Once in a while, there's something that happens where we'll do that. But anyway, those are kind of I think the things that are important to know about this particular question.